This is the Definitely Uncertain podcast, brought to you by Goldrock Capital. Each week, we look at how high net worth families can improve their lives, decisions, and investments in a deeply uncertain world. We always aim to provide practical information, even if we can't offer specific investment advice. Welcome to the Definitely Uncertain podcast. My name is Darren Rockman, and I'm a partner at Goldrock Capital, the 21-year-old multifamily office servicing families in Israel and around the world. And today on the podcast, I'm very pleased to welcome Matt Rubin. Hi, Matt.
Hi, Darren. Nice to see you.
Nice to see you too. So Matt is the managing partner and chief investment officer of Matrix Private Capital Group in New York. They are a diversified asset manager, which Matt founded together with Richard Fuld, the former chairman and CEO of Lehman Brothers. And prior to that, Matt was the managing director of Neuberger Berman in New York, where he chaired the firm's asset allocation committee. And prior to that, he was at Morgan Stanley, a single family office in the US trust companies. So that means that Matt knows more about building diversified portfolios for investors than almost anybody else on the planet. And it's probably forgotten more about or knows more about asset management than most people have forgotten. So we're really happy to have you on Definitely Uncertain.
Glad to be here.
So Matt, let's start off talking about equity markets. And we've been through this great bull run despite the dip down into 2020 during the height of the COVID crisis. How are you advising clients today? What's your sort of view on where equity markets are and where they're going?
So look, we've been waiting for a pullback or correction here for a long time, for multiple years, and coming up on a decade. We believe that equity markets are actually stronger than many people believe that they are, and will continue to be stronger. We're actually quite constructive on equity markets going through the end of the year. So we've been advising clients to really take a risk-on stance in their portfolio today.
Right. And how does that sort of translate into 2022 in your view? Does that correction
2022? Well, look, I think the big question, Darren, is around inflation and what the impact is going to be there and how that's going to play out in 2022. I think we'll talk more about it, whether it's transient or more structural. But we believe that what we're seeing right now as far as inflationary pressures today is really the economy getting reopened. The Fed's got its work to do. And as we remove some of this liquidity from the economy, both here in the US and globally, markets could get choppier. But right now, we think there's an opportunity to continue to be in risk assets and equities.
Okay. And within that equity complex, are you more focused on the US or are you looking elsewhere?
So really the developed markets. So predominantly the US, looking at developed markets in Europe as well as elsewhere globally, but more focused on the developed markets. We think the developed markets are really going to lead us out of the COVID era as we see more vaccines and as we see these markets come back and these economies come back faster than you are going to see in the emerging markets likely.
Okay. And of course, the Chinese market's been buffeted by all the changes, regulatory government generated, obviously the issues around bankruptcies. How do and that's a huge market and was a big part of portfolios going into 2021. What's your view there?
So we're actually less constructive on China. We think China is clearly hitting a patch, despite all the geopolitical issues of sort of slower growth at this point in time. We've seen China play out. Actually, I think it's today or tomorrow is the anniversary of when the term coined BRICS, whether the BRICS term was coined, which is hard to believe. And it's really been interesting to see the way it's played out in Brazil, Russia, India, and China. India and China have certainly been sort of the bellwethers there, where I'd say Brazil and Russia have been a little bit more disappointing. But as far as China is concerned, given where we are in the growth cycle and that we expect to see slower growth, on top of all the geopolitical issues, on top of all of the bankruptcy issues that we're seeing today, we've really tempered our allocation and exposure to China at this point in time.
Okay. So you mentioned inflation a moment ago and the sort of, multi-trillion dollar question, which is the inflation we're seeing permanent or transient? So where is Matt Rubin in that question?
So I think I'm somewhere in between, like strategists like to say, directionally.
Okay.
I would say that if we really think it's going to be somewhat intermediate, this inflation. I think when you look at the structural issues, the demographic issues here in the U.S., I think it's going to be really hard to see long-term inflation. Remember, as we entered this crisis, this COVID crisis, everyone was much more concerned about a deflationary
Yes.
environment than an inflationary environment. So I think that we are maybe becoming too cautious around inflation and maybe taking less caution around deflation. I need to switch that up a little bit. So just to answer your question, Darren, sort of more succinctly, I think intermediate term inflation, I don't think this is going to be just a bleep. I think it's going to carry into sort of the subsequent years, but I don't think we're headed for a long-term hyperinflationary period.
Okay. I, as I mentioned before we started the show, I spent a bit of time in the South over the last few weeks in the United States. And, I was shocked by the fact that everywhere you went, there were job advertisements on the streets, on the radio, on billboards. There seems to be a real employment crunch. Certainly, I was in North Carolina, Virginia, and Tennessee. So, how is that factoring in?
It's a really good question. People don't want to go back to work here in the U.S. It seems. I think a couple of things are happening there. One, I think this gig economy and what's happening sort of with people being self-employed and being able to turn on an app and work when they want to work has really changed a little bit of the structural issues around the way people think about working today. I think there's a different mindset to it than necessarily having a 9-to-5 job. But with that, I do think we are seeing a shortage right now of workers. And that is in a combination of not only this gig economy that we're seeing, but also the fact that there's been just so much stimulus here in the US that people are sitting and they're less concerned about going back to work right now. Let's watch on Friday. I'm not sure when the podcast will be released, but on Friday, we're going to see an interesting jobs number. It'll be very interesting to see what workforce is back in play come Friday.
Right. Okay. So then, intermediate, your view is, that's probably the next, year or two that we're going to have some inflation not turning into something that's out of control. How does that impact, obviously, Fed thinking and particularly equity prices?
So I think to be in the equity market right now it certainly makes sense. I think like I said, much more constructive on equities than fixed income. I think fixed income right now could be coined fixed no income, or it's not even fixed in many situations or instances. So we have to be really careful there. I think that if we see an environment where we see modest growth and we don't find ourselves in an hyperinflationary environment, I think equities are a good place to be. The problem, Darren, is if we find ourselves in an environment where we see significant inflation and growth falls off. And that could be a stagflationary environment. That's the worst case scenario, but we don't think that's the base case scenario.
Okay. And then within, considering that within the equity world, are there, are you more biased towards growth? Are you more biased towards value? Are there certain sectors that you really like or don't like?
So in the short term, one of the things we do internally is we run a thematic oriented portfolio, which invests in both sectors and specific industries. And right now, the portfolio is positioned in more of a risk-on fashion, looking at things that are more cyclically oriented, like home builders, like energy, and like financials. So the portfolio is definitely taking that stance, and that's where we expect to be through the end of the year. We'll have to take a look in the beginning of 2022 and see if that's going to change. We've certainly been in a growth market for an extended period of time from an allocation perspective.
Matt, you didn't mention technology in those three industries.
So certainly we have exposure to technology strategically. We're market weight in technology. I think we have to watch what's happening from an interest rate perspective to see what the future of the technology asset class will be in the short and the intermediate term. So right now, they're more bullish on sort of cyclically oriented sectors and themes as opposed to the growth and technology sector.
Okay. So, all right. So now you touched on fixed income, which is one thing that I wanted to ask you about. How does an asset allocator like yourself, who's probably was educated and, throughout his career was creating balanced portfolios of bonds on one side and equities on the other. And now you find yourself in this world where, it's so hard to hold bonds because they don't earn you any money, and interest rates are so low that it seems that there's only one way to go, and that's down. So how do you build a portfolio when one of the legs of that portfolio is now sort of chopped from underneath you?
That's an excellent question. The traditional balanced portfolio is sort of dead because you can't really expect out of fixed income what you had historically expect out of fixed income. However, one of the biggest mistakes I think allocators are making today are not using any fixed income or cash in a client's allocation because it still really creates the ballast of a portfolio. If you could own something that is not directly correlated with the equity market, even if you're not getting a whole lot of yield from it, from a risk management tool perspective, it's really important.
And if you compare the extent to that allocation once upon a time, let's say 5 or 6 years ago to today, give us some sort of numbers, in the way that you think and model things out.
Sure. So if you looked at a traditional 60-40 portfolio, you really have to look for alternatives to the fixed income portion of the portfolio today. So where you would have historically had more duration, we certainly look to have more credit risk in the portfolio today as opposed to duration risk. We'd also look to hold more cash. So really a barbell approach within fixed income as opposed to your more traditional laddered intermediate like fixed income exposure.
Okay. Would that 60-40 look more like 70-30 or 80-20 today? Or are you sort of sticking to that 60-40 but just playing around with the 40% in bonds?
No, both, to your point. So when we build an investment policy, we build bands around the asset classes. And if you look at the bands within the equity asset class and the fixed income asset class, we're at the upper end of the bands for equities and lower end of the bands for fixed income.
Okay. And within that sort of fixed income portion, are you using less traditional instruments as well, private lending or real estate debt or those types of things in order to replace some of the fixed income?
Yeah, absolutely. So we are in the private markets. We're looking at private debt, private credit in both the traditional equity markets, but also in the real estate markets. We also use a number of structured products, diversifying across issuer to make sure we're not taking inappropriate credit risk, but we are looking at alternatives in the fixed income space.
All right. Let's just a word on cash. So how do you think about cash in the portfolio? We here at the office, we have clients that say to us, why would I ever want to hold cash? It's burning a hole in my pocket. And you can understand the thinking. How do you think about it?
We think about cash as sort of a part of both not only the strategic but tactical allocation. Two things. One, we want to be able to be opportunistic when markets present themselves to be able to take advantage of them, which they will. Even though we're constructive, we do think it'll get choppy at some point. And then two, strategically, it's a proxy or a surrogate for traditional fixed income. Unfortunately, you're not earning a return from it today, but hopefully it is creating that ballast.
Right. Okay. Interesting. One other sort of aspect to that, which is, I suppose, the flip side of cash, is leverage. And one of the things we've seen families do was actually take leverage against equity portfolios, in a measured manner, simply because again rates are so low, cash is freely available, and equities have been a great bet. And on the other hand, we've sort of seen the other view, which is a more conservative. I don't want to take direct leverage on my portfolio. I don't need to do that. So, have you seen families take leverage? How do you think about it?
Sure. Yeah. Well, we think about leverage in two ways, actually three ways. One, leveraging the portfolio in a traditional balance sheet way and borrowing against the portfolio to lever and to add more opportunity to the portfolio. Two, from a just an overall asset allocation technique, given where we are with capital gains taxes and some of the issues around taxation generally, we use leverage for lifestyle purposes. So clients will
Right.
borrow against their portfolio for living expenses. And then third, Darren, will use things like options and futures to where there's embedded leverage, where sometimes the cost is even less than your traditional leverage to build around the portfolio. With that said, I wouldn't say we have an explicit view on leverage. It's really more in the context of trying to achieve the underlying client's goal and objective in the portfolio construction.
Right, right. So it sounds that it's less around trying to juice up returns and more around solving specific issues for a client. Is that right?
That's well said. Well said. Okay. Perfect. Yes, exactly.
Okay. All right, good. And I suppose sort of to round off the conversation, the one element that we've not really touched on has been the alternate universe, particularly private equity, venture capital. We talked a little bit about private debt, obviously real estate. Are you seeing that that's becoming a larger part of your portfolio?
Absolutely. Absolutely. We see outsized returns in the private markets, specifically in the private equity markets, both in traditional buyout as well as venture capital. It's also exciting for clients. Clients want to be invested in deals. It's an exciting aspect of the portfolio. So we're more and more allocating to the space.
Right. And you mentioned deals. What's your view on deals versus funds? Because they're within the family office world, there are, I suppose, two views. One is, I want to do deals, clients like it, you get to feel you own something, you have the possibility of outsized returns. And the other side of it, which is to say, well, very, very specific risk, all your eggs in one basket, you're much better off going to a manager, paying 2 and 20 and getting a blended return.
I believe it's a combination of both, Darren. I think the private equity funds, you really need to build a private equity beta to the portfolio. You really want to have an allocation that's going to be more evergreen to private equity diversified funds. Where you're going to find the traditional outsized returns, I think, are in both specialty funds, but also in direct deals. I do think, though, the direct deal space is probably the next bubble that we're looking at in the family office arena. There's a lot of money chasing not that many deals, or I should say not that many good deals. So we must be really careful.
Right. And how do you advise families who are interested in doing direct deals? What do you tell them not to do or to avoid?
So, well, first of all, avoid no one's ever heard a bad deal, so to speak, when they hear about the deals. I think you really got to avoid the cocktail chatter. With that, it requires the proper due diligence. So we've done some direct deals, and we'll do them by doing the diligence alongside a sponsor or a management team, and then executing upon the deal. We never want to be too smart because we're always humbled.
Right. Yeah, we've been around too long, you and me, to get too excited about anything.
Fair.
I often find myself in conversations with clients, and they've never seen a deal that they don't like, and I never saw a deal that I did like. So somewhere in between, we managed to get things done.
The barbell approach.
The barbell approach, exactly. And within the sort of private equity world, there is the sort of big end of buyout all the way through to sort of the lower middle market. Thematically, when you talk about specialty funds, what are the types of things that you actually like these days, and what are the things that you feel maybe it's too hot and you want to stay away?
So I think we got to be really sensitive in the mega buyout space. I think those have become really asset gathering funds in many instances, as opposed to alpha driven funds. We're excited about the lower middle market. We're excited about certain opportunities in venture, explicitly in Israel. I think there's a tremendous amount going on there, which I know we've talked about. And then also in specialty asset classes like direct lending. Those are asset classes, as we've seen banks sort of abandon that space. Yeah. We've seen firms be able to really get in, and funds be able to really get in and do a good job in producing returns, which are often non-correlated to other areas because of the idiosyncratic risk. So we like that. We like that aspect of the private markets as well.
Right. And are you able to identify these days assets which are truly non-correlated? that you think are correlated negatively to equity markets, or is that getting harder?
It's getting harder and harder. I mean, correlations have really broken down. Even things that traditionally you'd expect to be correlated, like you look at days where you see things in the rates market where you'd say, oh, obviously gold will be up today,
right?
And it's the direct opposite. But you have to look, Darren, to find things that are truly non-correlated. I really think you need to look very specialized in things like reinsurance and things that really have no exposure to the equity markets or the economy generally, which is harder and harder to find.
Yeah, they're not big markets. Things like litigation funding and royalties and those types of things.
Yeah. They're very small and niche markets, absolutely.
Yeah. Hard to build a portfolio just based on, or a big part of your portfolio based on that. Well, Matt, you've been doing this for a very long time, and you advise some of the best or the biggest and brightest out there, which means that you're by definition one of the smart ones too. So, what's the hardest part of the asset allocation business from your perspective?
I think the emotional part. I think the behavioral part. People underestimate how much psychology is in this business. I think everyone thinks about it as being very quantitatively driven. There's a real emotional part, and behavioral aspects could get in the way.
Right.
And you have to kind of ward those off constantly. I would say that's the hardest part. The math is one thing, learning the science behind it, that's academic, but the emotions are tough to harness.
Right. And what do you view as your role when you end up at points of stress or points of greed? Let's compare sort of April last year to June this year, where April last year looked like the end was nigh, and June this year everybody's partying like it's 1999.
Yeah, it's tough, and look, it's tough because we are human beings. And obviously clients are human beings. And at the end of the day, investing is really driven by fear and greed. Those are the two primal emotions. And to be able to manage them, not only for yourself, but for clients as well, is challenging. I think you have to kind of take the longer term perspective. I think to be reactive as an asset allocator is really dangerous. I think you need to think about not what's happening today, but what's likely to happen in the coming days.
Right. Okay. Excellent. Well, that was really hugely helpful, Matt. I wanted to thank you for joining Definitely Uncertain, and really appreciate your wisdom.
It was a pleasure. Thanks for having me, Darren.
All right, then. Well, best of luck as we move towards the end of the year, and thank you everybody for tuning in this time. There'll be more episodes coming in the coming weeks, and in the meantime, I hope you're all well, and thanks for listening. Bye-bye.